Hello everyone! In this video, we will learn about the Credit Default Swap, or CDS. When you lend money or invest in bonds or debentures, there's a risk that the borrower won't repay the interest or the principal. A Credit Default Swap, or CDS, protects the investors or lenders against such risks. A credit default swap is the most common type of credit derivative and works like an insurance policy. Just like paying regular premiums to an insurance company, the CDS buyer makes periodic payments to the CDS seller. If a specified credit event occurs, the CDS seller compensates the buyer for the loss. Let's understand this better with an example. Mr. Oliver holds $1 million in bonds issued by Atlas Industries, paying a 5% coupon and maturing in 3 years. Although the company has been making payments on time, Mr. Oliver is concerned that it might face financial trouble soon and could potentially default on both interest and principal repayments. To manage this risk, Mr. Oliver enters a CDS contract with a dealer, agreeing to pay an annual premium of 1% of the notional principal amount of $1 million. That's $10,000 each year. He'll continue paying this premium as long as he seeks protection or until the bond matures. If Atlas doesn't default, the dealer keeps the premiums. Mr. Oliver is the protection buyer, the dealer is the protection seller, Atlas Industries is the reference entity, and the bond issued by Atlas is the reference obligation. The premium is called as the spread and is measured in terms of basis points. Remember, 1% is equivalent to 100 basis points. If Atlas Industries pays the coupons for year 1 and subsequently defaults on the promised coupon or interest payments from year 2 onwards, a credit event is triggered, and the CDS must be settled. The settlement can either be physical or cash-based. Let's understand the physical settlement of CDS. Physical settlement is used when the investor is actually holding the bond and wants to hedge his risk. In this case, since Mr. Oliver owns the bond, he would prefer a physical settlement. To keep it simple, we will assume that if Atlas defaults, Mr. Oliver will hand over the bond to the dealer. In return, the dealer will pay him the bond's par value of $1 million. However, any missed coupon payments are not separately compensated. Oliver bears that loss. The CDS covers only the principal, not the missed interest. After settlement, if the company makes any payments towards the bonds, the dealer, as the new bondholder, will receive them. Usually, when a company defaults on its bonds, investors do not lose the entire amount. They may recover a portion of it through liquidation or settlement with the issuer. This amount reflects the market value of the defaulted bond, which is based on a recovery rate set during an ISTA credit event auction. In a cash-settled CDS, the dealer pays Mr. Oliver the difference between the bond's par value and its market value after default. For example, if a bond has a face value of $1 million and the recovery rate is 60%, the CDS payout would be 40% of the face value, or $400,000. Mr. Oliver keeps the bond, which now has a market value of $600,000. The settlement amount is calculated using the formula shown here. You can pause the video now to take a look. Remember that in cash settlement, the underlying bond is not exchanged between the parties. Now, you may be surprised to know that CDS can be bought by anyone, even if they haven't lent money or invested in bonds. For example, if you believe Atlas Industries will default on its bond repayment, you can buy a CDS on their debt even if you do not own any of their bonds. These contracts are called naked CDS, and they have historically accounted for a large share of the market. Naked CDS are speculative and are always settled in cash. In such a case, you enter into a CDS contract with a dealer, pay the premium, and if Atlas Industries defaults, you receive the settlement amount from the dealer, even though you do not hold the bond. Isn't this a super risky bet? The underlying asset in a CDS can be any loan, corporate or government bond, mortgage-backed securities, asset-backed securities, and more. A range of risks such as default, downgrade, bankruptcy, or debt restructuring can be covered as credit events and can trigger a CDS payout. We'll cover mortgage-backed securities and asset-backed securities in a special video. While CDS are used to mitigate credit risk, they don't eliminate it. They simply shift the risk. Mr. Oliver was originally facing credit risk from Atlas Industries, but now, if Atlas defaults, he also faces credit risk from the dealer, as the dealer could also default. This is called counterparty risk. The rationale behind taking positions in CDS is simple. The protection buyer believes the reference entity might default and seeks compensation if that happens. The protection seller believes the reference entity won't default and expects to keep the premium collected. During the 2007-2008 global financial crisis, major CDS sellers like AIG, Washington Mutual, Lehman Brothers, Merrill Lynch, etc. suffered massive losses, defaulted on their payment obligations, and in some cases went bankrupt. This led Warren Buffett to famously call CDS financial weapons of mass destruction. That's it for this video. See you next time. Happy learning!